Stock market reaching all-time highs, and that has a lot of retail investors, individuals thinking about getting off the sidelines. That may not be the best idea. We're going to talk about what exactly is happening, fund inflows, fund outflows, where these investors are coming from, and what it means for you and your investing strategy. That and so much more on this edition of Money in the Morning. Welcome to Money in the Morning. I'm Bobby Rebell from the Financial Grown Up Podcast, coming to you from my very grown up kitchen in New York City. My partner, Joe Saul-Sehy, normally comes to you from his mom's half-finished basement, but he has the day off. Can you imagine that? Anyway, we will be discussing that big headline that I mentioned about investors. We'll be not just reading it like some podcasts do, but we're actually going to be breaking it down and telling you what you can take from it, what you can learn from it to basically go on and live a richer life. Money in the Morning is brought to you by Tiller. Manage your money 10 times faster in a spreadsheet with Tiller, the only service that connects your banks to Google Sheets and Excel with your daily spending, transactions, and balances. Go to stackingbenjamins.com/Tiller for more. All right, good morning, everyone. And this has been a great time for many investors. We'd love to see the market go up because that means most of us who are playing the long game when it comes to stocks are earning money or making money, and that's generally a good thing. But there are some things, some red flags out there that we're going to be talking about with our first story. Let's go to Laura.
Good morning. You supply the coffee. We'll bring the headlines. Here they come.
Let's move on to our second headline. So this headline actually comes to us from MarketWatch, and it is from Chris Matthews, and it begins. Individual investors finally turn bullish as stock market nears all-time highs. Individual investors are ready to go. First of all, as someone that's been covering the market for quite some time, that headline in and of itself really scares me. So little alarms were going off when I heard that. Here's how the article begins. This year's stock market rally has been impressive, especially as it occurred in an environment where individual investors have remained cautious, as evidenced by survey data and fund flow figures, which have shown consistent equity fund outflows in 2019. But individual investors are once again wading into the market, indicating renewed bullishness in surveys and flow data released in recent days. These bulls should beware, however, as swings in sentiment can sometimes serve as a contrarian indicator, signaling that stocks may underperform in the months ahead. The latest E-Trade Streetwise survey released Friday, showed 58% self-directed investors calling themselves bullish on the stock market in the second quarter of this year, a 12 percentage point increase from the first quarter when a 54% majority indicated they were bearish in their stock market outlook. Quote, a cloud over the market has been lifted now that investors aren't worried about the Fed being too aggressive. And we are also seeing signs of a potential breakthrough on the U.S.-China trade front. That's a quote from Mike Loengart, Vice President of Investment Strategy at E-Trade, arguing that these factors have helped convince his clients that there is room left to run in the current bull market. He added that the hangover from the nearly 20% drawdown in the S&P 500 in the final quarter of last year stayed with them in the first quarter, causing many to miss out on at least part of this year's rally. Quote, it speaks to the emotional challenge that all investors are presented with when it comes to maintaining a longer-term point of view. It's no secret that smaller retail investors chase performance. Let me say that again. That's an important thing. It's no secret that smaller retail investors chase performance. That is a trend that's unfortunately ever present. And again, that is a quote from Mr. Loengart from E-Trade. Indeed, it may be the case that individual investors are chasing performance now, given the market's rapid first quarter rise and projections of muted earnings growth in 2019. For instance, a recent survey from the American Association of Individual Investors also showed investor sentiment improving in the week ended April 10th, with 40.3% of respondents predicting that stocks will increase in value over the next 6 months, somewhat above the historic average of 38.5%. Meanwhile, bearish sentiment, or the belief that stocks will fall over the next 6 months, fell to the, quote, unusually low level of 20.7%, according to a statement accompanying the results, well below the historic average of 30.5%. But this low level of bearishness is actually something of a contrarian signal for stocks, according to AAII. Historically, the S&P 500 index has realized lower than average and lower than median 6-month returns following unusually low bearish sentiment readings. Meanwhile, the latest fund flow data from Lipper show that U.S. equity funds saw a $4.3 billion inflows in the week of April 10th versus $19.7 billion of outflow for domestic equity funds from the start of the year through April 3rd. And also during the week of April 10th, there were $8.4 billion in outflows from cash-like money market funds, mutual funds, according to Lipper, suggesting investors are moving cash from the sidelines into the U.S. stock market. So that is a lot going on. And I think it's important to focus on the mentality of what's going on here, because we have to take the emotion out. And it sounds like a lot of people are making emotional investments and they are not sticking to what they had planned, or maybe they don't have a plan. More likely, they don't even have a plan. And they're seeing that the market is getting away from them. A lot of FOMO, fear of missing out, is what it sounds like is going on. And in fact, what would be wiser for many of them would be to take the emotion out and not worry about what's going on with other people, but worry instead about what their goals are, what they want to accomplish with that money, the returns that they hope to see from their investments and how they're going to get there, and not so much focus on chasing performance. So for example, automated dollar cost averaging is something that is really useful and a good way to stay disciplined when you don't quite know when to get in, because we all know that if you invest low and sell high, you're going to do great. Easy peasy. But the problem is nobody really knows when that is happening. Nobody knows when the market's at a low, because it's very hard. For example, it talks in the piece about the fourth quarter of 2018 sounded like a bad time to invest because the market was going down. People were so worried about all these different things going on, from China to a recession to, frankly, unpredictable political stuff going on, which is kind of always the case, at least in recent years, if we're being honest. There are so many variables that could impact the stock market that you could drive yourself crazy trying to pinpoint it. And the truth is, if you go to a cocktail party, if you're at work just hanging out with your coworkers and people happen to talk about the market or their investments, even their 401ks or their IRAs, and maybe they made big contributions because we're rolling out of tax season and they made last minute contributions to their retirement funds, and they're talking about how that's going and how their investments are performing, and you do get FOMO, you do get fear of missing out. It's not going to pay off if you start chasing it. That doesn't mean you should not invest when the market is near all-time highs. It means that you have to have a thoughtful investment strategy that is separate from what is going on in terms of the short-term, day-to-day market fluctuations. And I want to just take a quick comment from Kathy. She says, no such thing as quick, easy money, at least not in the real world. Exactly. So the people that you hear talking about the easy money they're making, it may be completely true if you are talking to, your taxi driver or somebody that you encounter who comes to, work on your house, or that you are seeing the barista at the coffee place, whatever it may be, and they happen to mention their great investment. And it may not be the stereotype of the hot stock that we heard in previous big market rallies, where you hear about this big thing happening in this one stock, the hot stock that made them all this money. There may be other things that are getting people excited and getting more people, more retail investors off the sidelines, or maybe making their first time investments because they're hearing this buzz. People get excited when they hear all these news reports that talk about the success that other people are having in the stock market, how the market is at all-time highs, and how it just seems to go up every day. And it's almost like when you get those the cookies in your email, and you looked at a book that you thought you were going to buy, and then every day you log in and that book keeps being shown to you until you finally maybe just give into it and you buy that thing that they're showing you. It's the same thing with the stock market. Suddenly you wake up and everyone's coming at you with, oh, the stock market is higher. Oh, this is happening. And it makes you more interested. And so I guess the takeaway from this, when we start talking about it, is people get excited. They might have a hot stock tip. Or maybe they're talking about all the cool IPOs because we hear about Pinterest is coming to market, Uber's coming to market. We heard about Lyft. That was really exciting. Maybe not so much after the fact, but we hear about all of these deals and the excitement around them. And people are talking about maybe their ETFs, which is an exchange traded fund, and how great that is versus a mutual fund. Or maybe they have a mutual fund that they love. Or maybe they're talking about their low cost index fund and how great that is. Maybe they're just talking about how much money they're making. And then you start to feel bad. You start to feel left out. And you start to think about how much money you could have been making if only you weren't still on the sidelines. And you have that temptation to just rush in. But here's the thing that you need to think about. Those people that are talking to you, again, stereotype is always the taxi driver, but it's anyone around you. And they're telling you how great their investments are. Well, try to remember the last time someone came up to you, prompted or maybe even unprompted, that you asked. I said that reverse. Sometimes unprompted, just out of the blue, but maybe even you asked them, how are your investments going or something like that. And they started telling you how awful it was. They started telling you that they bet on this IPO or they bet on this hot stock or they just invested in something kind of responsible, like a index fund with a low cost, but maybe it went down. You tend to not hear those conversations. You tend to not hear about the cool hedge fund that their brother-in-law got them into that is maybe not doing so well right now. And you also tend to not hear about how much they bet on something. Maybe they don't tell you that they bet against Tiger Woods in a golf tournament. Maybe they don't tell you whatever it is that went wrong because it's not really a very fun conversation. It's a lot more fun to tell you just about the tiny bit of what's going on that's working for them. It's human nature. I don't blame them. I'm sure to some degree, we've all been there. We've all done that in our own way. The truth is that it never happens, though. We rarely go out and brag to people that we just completely missed the ball and made a terrible bet because that's no fun, right? So if you have FOMO, that's okay. It's okay to have that need to win and that desire, frankly, human nature, to keep up with your friends that are doing very well. But doing what E-Trade's Lowengardt calls chasing performance is really hard to do. And it's a funny thing because performance really can't be caught. It is elusive. And if you try, performance will very much leave you in the dust. You have to be on board in time. But here's the thing. No one gives you the starting time. And guessing is not going to get there. So you have to just get on board when it's the right time in your life. And just to take a quick audience comment here from our Facebook Live audience, Mike is chiming in, so true, you never hear about the losses. Exactly. It's possible you could, but personally for me, I was thinking about this before we started taping the show, and I could not come up with one time that someone came to me and said that they invested in a specific stock or any investment, frankly, and it was just such a dud and I should stay away from it. Because why would you, right? Why would you bother with that? Who needs to air your losses? But if you're excited about something that's going well, even if it's going well for a day, think about someone that invested in, let's say, Lyft stock the day it went public and they were able to get out and, bank some money. Well, good for them. That's great. But that doesn't mean that's something that's right for you or that you even have the opportunity to necessarily replicate. Somebody may have made money last week on something, but those gains are already priced in. So everything has to be taken in context. And as I said, the takeaway is if you chase performance, it will leave you in the dust. Before we get to our big idea, and I do see some members of our Facebook Live audience, at least one of them has an interesting guess. I do want to talk about the fact that one way to make sure that you stay on top of your goals, your financial goals, which include obviously investing in the time that is right for you or at the time that is correct for you, is being organized with your finances. And that's why we love to partner with Tiller here at Money in the Morning, because they really understand the importance of being organized and how it can, if you can see in front of you in a clear way, and Tiller presents everything very clearly in spreadsheets using Google Sheets or even Excel, you can see what's going on with your money. And then you can see, for example, what do I have that I can put in motion for a dollar cost averaging investment plan, if that's what's right for me. You can see your daily spending, you can see your transactions, and always most important, you can see those bottom line balances. If you want to check it out, go to stackingbenjamins.com/Tiller for more info. And as you guys know that are regular listeners, we get a thank you if you use that link, and that helps to support the show. So please, if it's right for you, use our link. If it's not right for you, that's okay too. But we really appreciate your support with for the show. And I just want to give, oh no, one more quick comment from our audience, and this is from Barry. He says, I put $1,000 into the company that owns MoviePass, and within a couple of months, it was worth like 20 cents, not exaggerating. So there we finally got a money loss confession. I wanted to get that in there just so we can sort of be that 1% to the 99% of the time. No one actually wants to tell you about their losses, but there is that 1% of the time, I guess. And we have Barry as our example that people will come forward. Thank you very much, Barry, in our Facebook Live audience, and confess to a loss. So that was a lot of fun, Barry. Thank you so much. Let's now get to our big idea. And we want to talk about focusing on the data, not necessarily the results when you're changing course. Because when we look, for example, at these bets that were made on the Masters tournament and on Tiger Woods, there was a plan. There was data. It was analyzed. The odds were not just made up. These were done through statistics and through actual research that statistically, the odds were in the favor of these companies, not in the favor of the guy that bet $85,000 on Tiger Woods. So they didn't do the wrong thing. Sure, they came up empty this time because odds are only odds. There's always the fraction of the occasional times that someone's going to not be with the odds. That's kind of what makes life fun too, by the way. But you can't change course just because, well, I don't like this. You have to ask yourself, what is the data behind the decision? So for the Tiger Woods bet, for example, all the data was behind Tiger Woods not winning. The odds are, again, nothing certain, just odds. If this company were to rerun this bet with the same statistics and the same odds, they might win the next time. Their strategy was correct. So it doesn't make sense to change their strategy. And for the stock market, on the sidelines, if you're on the sidelines, you have to really be thinking about your goals, not about what's going on short term in the market. You have to think about what are you hoping to achieve with your investable assets, and what is your timeline? Is it far away or is it short term? Short term, you're going to have a really tough time because that's just really a roll of the dice. Anything could happen in the short term. But if you look at the data and you look at the timing of things, long term, the odds are going to be much more in your favor. And so it's really important not to play the short-term gain. The data around the market timing will show you that if you try to time the market, you are going to have horrible results. The data around your gut feeling beating the market, oh my gosh, just forget that. So the important thing is to think about the gift of time, because that is going to pay pretty well if you look at the historic data. And that is going to be a big win for everyone. Noodle that for a minute. All right, I did not get to Kathy, who had a guess on the big idea. Let me just get that in there. She said, stick with what you know. And I thank you for that, Kathy, because that is very close. You want to stick with what you know, and you also want to stick with what your plan was, because what your plan was, if it was thoughtful and put together in a rational way, based on data, based on your goals, based on your time horizon, based on what you want to happen, nothing changes if one time in the short term it doesn't work out. The odds will still be in your favor. And with that, I want to thank everyone for joining us for this edition of Money in the Morning. Joe Saul-Sehy, my partner, will be back later this week. And he would be telling you to go stack some Benjamins. But I'm going to also tell you that if you want to live a rich life, you have to be a financial grown-up. Bye, everyone, and thank you for being part of the show.
This show is created by Joe Saul-Sehy, hosted and produced by Bobby Rebell and Joe Saul-Sehy, is engineered by Caden Thompson, and all put together by a pack of well-trained ferrets down here in Joe's mom's basement. You'll find Bobby at the Financial Grown-Up Podcast and Joe at the Stacking Benjamin Show. Go say hi to them there, too. Online, visit us on Twitter at Average Joe Money and at Bobby Rebell, or come join a live recording at our Facebook page. That's facebook.com/iStackBenjamins. I know you already know this too, but Money in the Morning is for entertainment purposes only. You should not act on anything recommended by a bunch of entertainers in a basement or even a Manhattan kitchen without first consulting your financial advisor. And second, dude, have your head examined. Have headlines you'd like us to discuss? Send them to joe@stackingbenjamins.com or put them on our Stacking Benjamins closed Facebook group. This show is a collaboration of Stacking Benjamins LLC and BRK Media LLC. Copyright 2019. All rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.